The bond market has been all over the news recently. First, it was because, quote, the bond market was flashing warning signs for investors. Then it was because of news of a global bond market sell-off. And now Wall Street is saying it's getting worse, with Wall Street saying that the bond market is signaling trouble ahead for our economy. Now, I feel like most people, and you have no idea what the bond market is, what's happening, and what this means for people and investors, you're in the right place because I'm going to break it all down. I'm going to start by explaining what the bond market is, that way we're all on the same page so you can understand what's happening and what happened in the bond market recently. And then we're going to wrap this video up by talking about what might be coming in the bond market and outside of that in our economy and investments. That way you can make smarter decisions with your money. So let's break this down, starting with number one. What in the world is the bond market? If I believed in the future of McDonald's, there's two ways I can invest my money in the McDonald's company and bet on McDonald's. Number one is I can go to the stock market and buy shares of MCD. This is the ticker symbol for McDonald's. And when I buy one share, one stock of McDonald's, I become one of the owners of McDonald's. And as McDonald's makes more money, they make more profits, I would get bigger dividends, and hopefully my stock price would go up. That's the first way. But the second way that I can invest in McDonald's is by lending money to McDonald's, because McDonald's uses debt to grow the business. And when they go out and they borrow this money, they can borrow this money from banks or from regular investors. And when you go and buy shares in McDonald's, you do this in the stock market. When you go and lend money to McDonald's, you do that from the bond market. But the one key difference between the stock market and the bond market is when you're investing in stocks, you're investing for profits. You want to see the value of your stock go up. When you're investing in the bond market, you are working for interest payments. It doesn't matter how big McDonald's profits are. All you're going to get is your guaranteed interest. If McDonald's drops in value, if McDonald's loses money, this doesn't matter to you here because you still should be entitled to your interest payments. I say should be because if McDonald's goes bankrupt, well, you might not get this. But here, you're limited by how much you earn because you're working for interest payments. Here, there's no limit, you're working for profits. But this is where things start to get even more interesting, because in the bond market, you can lend money not just to corporations like McDonald's, but you can also lend money to the United States government. This is called a treasury. So if you invest your money into a United States treasury, you are lending your money to the United States government, again, in exchange for interest payments. And just so we're on the same page, there are three different types of treasuries that you can invest in. You can invest in treasury bills, treasury notes, treasury bonds. I'm gonna keep it super simple because the only difference between these three is how long the loan lasts for. A treasury bill is a loan to the United States government that lasts 1 year or less. A treasury note is a loan that you give to the United States government that lasts 2 to 10 years. And a treasury bond is a loan you give to the United States government that lasts 20 or 30 years. That's the only difference between these three that you need to pay attention to. Now let's think about this from a perspective of an investor. What's the difference between investing your money in a corporate bond, like lending your money to McDonald's, versus investing your money in a treasury bond, which is lending your money to the United States government? And there are two key differences. Number one is taxes, because when you lend your money to the United States government, you are generally exempt, meaning you don't have to pay state and local taxes. You still have to pay your federal taxes, but you generally do not have to worry about state and local taxes here, but you do have to pay your state and local taxes on the interest payments you get here. And the second thing you want to think about is risk, because when you lend your money to McDonald's, well, McDonald's could go bankrupt. I mean, they could sell some really bad hamburgers and now they go bankrupt, and now you might not get any of your money back, let alone your interest payments. If you lend your money to the United States government, well, you better hope that they don't go bankrupt. Because yes, we could see big corporations go bankrupt. It has happened. We remember when Sears went bankrupt. But if the United States government were to go bankrupt, well, that's an even bigger problem. And this is why every economist will tell you that lending your money to the United States government, buying treasuries, is a risk-free investment because the government can always pay their bills. And the reason why the government can, quote unquote, always pay their bills is because of two reasons. Number one, they can tax you, citizens, more money. And number two, they can work with the Federal Reserve Bank to print unlimited amounts of money. And that's exactly why the bond market exists, is because if the government wants to keep spending more money, they can do it without raising your taxes. They can do it by borrowing more money, which also creates problems. But I'll get to that in a little bit, which brings me to number 2. Now that we've laid the foundation of what the bond market is and how the bond market works, let's talk about what's been happening in the bond market and why it's been on so many headlines lately. In short, bond yields, meaning interest rates, have been rising through 2025. Why? Because we've been seeing a bond sell-off happen. Now, to understand why this is so important, you need to know why bond prices move in the first place. And yes, this is something that we've been covering in Market Briefs. Again, Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in things like the economy, housing, stocks, crypto, and the global economy into a fun and witty and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every day. Plus, when you join Market Briefs, you'll also get my investing masterclass as a bonus, where I will teach you how you can start investing and find hidden investment opportunities by building an investing system for you. This investing masterclass is also free as a bonus when you sign up for Market Briefs. If you want to get Market Briefs and my investing masterclass, all you have to do is click the link below to sign up. To understand the price of a bond and the interest rates that bonds pay you, you have to think about supply and demand. What we've been seeing happen is that investors have been selling off their bonds. So when you sell something, generally the prices of that thing fall because now you have more sellers than you have buyers. And when everybody is selling, well, then that pushes the prices of something down. Think of it like the housing market. If everybody in your neighborhood listed their houses for sale, well, that would generally push home prices lower because now you have more supply than you have demand. But in the bond market, you also have to think about interest rates. Because if I'm the United States government and I need to incentivize you to lend money to me when people are selling off their bonds, I have to make this loan more attractive. And how can I make my loan more attractive when not enough people are lending money to me? Well, generally what you do is you have to see interest rates go up, because if people are selling off their bonds, there's a huge inventory of bonds available. Well, I have to attract you as an investor. And how do I do that? By offering you a higher interest rate. And this is what's been happening. We've been seeing bonds get sold off and yields, meaning interest rates, go up. Now, this might sound like a whole bunch of Wall Street noise, but you want to pay attention because, well, when these yields go up, you're the one that pays the price. Because when treasury yields go up, number one, that means that the United States government has to pay more interest on the national debt that they have. And we all know that the United States government has a whole lot of national debt, which explains why interest expenses for the government are the number one fastest growing expense for the United States government, meaning more of your tax dollars are not buying you services, it's paying for interest. But that's not all. Higher treasury yields also mean that your mortgage rates go up. Higher treasury yields also mean that you're going to pay higher interest rates when you get a car loan. And higher treasury yields also mean that business loan rates go up as well. The reason why the bond market influences every other loan out there is because when your bank, let's say JP Morgan Chase Bank, is deciding whether they should give you a mortgage or take that money and lend it to the United States government, they're going to compare risk and reward. You are more risky as an investment compared to the United States government. And if the United States government is paying out higher yields, meaning higher interest, well, they're going to lend their money to the United States government. That's why they say if you're going to buy a mortgage, you're going to have to pay more money than the United States government. So when these yields go up, you pay more money to the bank as well. And this brings us to really the root question you want to understand. Why are people selling off their bonds right now? Well, you got to remember, people generally buy treasury bonds as a source of security because it's kind of like a risk-free investment, which means they're going to sell those bonds when they lack the sense of security or potentially have a better investment somewhere else. And this now brings us to the most important part of this video, which is what's coming, because now you've understood what happened. In 2025, we've seen a lot of investors sell out of the United States treasuries, causing these bond yields to go up. But what's influencing these investors to ultimately sell off their bonds? And the answer is, it depends on who you ask. China is one of the largest investors into the United States treasury bond market, meaning lending money to the United States government. And over the last number of years, we've been seeing China sell off some of their treasuries. Why? Maybe because they want to distance themselves from the United States and the United States dollar. There's a lot of potential reasons why. I'm not going to go too deep into China right now, but that's the first thing you want to think about. Number two, more specific to 2025, concerns about tariffs and global trade wars have led to more investors selling off their treasury bonds. And number three, more concerns about the United States national debt and our national deficit has investors selling off some of their treasuries because they're worried about what this is going to do to the United States dollar. But instead of just focusing on those things, let's take one step back and think about this from the perspective of an investor. When you invest your money, I don't care what you invest in, what do you care about? Getting a return on your investment. And When we think about investing in treasuries, the reason why many people would be considering to sell that investment is because maybe they're worried about their potential returns. And we've been seeing more of those concerns pop up, not just in 2025, but over the last decade plus. All three major credit rating agencies have now downgraded the United States. It started in 2011 when S&P downgraded the United States for the first time after the government went into deep debt to stimulate the economy after the 2008 financial crisis. Then in 2023, Fitch downgraded the United States because of, quote, a high and growing general government debt burden. Well, in 2025, it was the icing on the cake when Moody's downgraded the United States because Moody's was concerned about the growing national debt and potentially shrinking tax revenue that could be coming in. Now, to be fair, despite all these downgrades, the United States still has an amazing credit rating, but it's not a perfect credit rating like it used to be, which has some investors potentially concerned about the United States' ability to keep paying off of those debts. And this ultimately goes back to the way that the United States government operates. The United States government has one source of revenue, and the revenue comes in from tax dollars from taxpayers. Now, what are those taxes? Because there's a lot of them. Well, you have your income taxes, you have your payroll taxes, you have your capital gains taxes, you have tariff taxes, you have sales taxes, and on and on and on and on and on. So you have all these taxes that the government uses to generate revenue. Then the United States government goes out and they spend money. These are the United States government expenses, whether it's on healthcare, whether it's on infrastructure, whether it's on the military, whether it's on paying back debt. But the problem is that these expenses far outweigh tax revenue. And what we've been seeing happen is that in order to spend this more money, the government could either raise your taxes or go out and borrow more money through the form of debt, which is these treasuries that we've been talking about all video. And yes, we've been seeing taxes generally go up in general, although the Trump tax bill is proposing to cut taxes significantly, but borrowing hasn't gone down. In fact, borrowing is going up. But this is where you have to understand, where is the United States government borrowing this money? And we've been talking about the bond market, so you might think, well, aren't they just borrowing money from the United States taxpayers? Isn't it just taxpayers that are lending money to the United States government? The answer is no. Like we talked about just a minute ago, China is lending money to the United States, Japan is lending money to the United States, the United Kingdom is lending money to the United States. So we have taxpayers, then we have governments, but still that's not enough either. There's one more source of lender to the United States, and that is the Federal Reserve Bank. And this is where the real problem starts, because the Federal Reserve Bank is the central bank of the United States, but although they're called the Federal Reserve Bank, they're actually not federal. It says so on the website. They're not a reserve because they're not sitting on any cash reserves, and they're not a bank. You and I can't go there to deposit money. So if the Federal Reserve Bank is lending these trillions of dollars to the United States government so they can spend money, you might be wondering, well, where's the Federal Reserve Bank getting their money if they're not federal and they don't have any cash? And the Federal Reserve Bank has this unique ability to essentially, poof, print money out of thin air. So now the United States government wants to spend a couple $1 trillion that they don't have. They want to build this big infrastructure project. Well, they could go out and raise your taxes, but you don't want to pay more money. I mean, who wants to pay more money in taxes? And this is where the United States government says, well, instead of raising taxes, how about we just borrow money from the Federal Reserve Bank? Now the Federal Reserve Bank lends the United States government a couple $1 trillion. They borrow the money, now they can spend the money and inject it into the economy. Now, when they build this infrastructure project, they hire construction companies, they pay asphalt companies, they pay concrete companies, the economy starts to boom, people get jobs. But there's a consequence, right? I mean, if the government could just print unlimited amounts of money, why do we have to pay taxes in the first place? And the reason is there is a consequence. There's a cost to printing this money out of thin air. What I used to say during the pandemic is the most expensive kind of money is free money. And the reason why you want to understand that is because when you don't understand who's paying the price, chances are it's probably you. Because this now is a form of tax. The only difference is this is a hidden tax. And the person who pays the price of this hidden tax is the average consumer. Because now this hidden tax is the form of inflation. Because what happens when you start printing more of these dollars is the value of each individual dollar goes down, causing the prices of things to go up. And when you have inflation, it hurts everybody, but it hurts certain people more than others. Because inflation, at the end of the day, hurts consumers, but it benefits investors. Because when I go into Walmart and I buy groceries and inflation happens, now I gotta pay more money for those avocados. When I go into Chipotle and inflation happens, I gotta pay more money for the extra guac. That hurts me as a consumer. And everybody's a consumer. Rich people, middle class people, poor people, everybody's a consumer. But at the same time, that exact same inflation is benefiting investors. Because while that inflation is happening, that means now more dollars are going into the hands of Walmart. More dollars are going into the hands of Chipotle. Who is that benefiting? Now you might think, well, it's benefiting the employees, right? Well, if you just look at the numbers, we see that generally employees' wages have not kept up with inflation. They've gone up, but generally not fast enough to keep up with inflation. So where do those extra dollars go? Well, they generally go into the hands of the shareholders, the investors, and those are the financially educated. So when you have a system like this, the investors are getting richer, the average person is becoming poorer. And it's not because you're not working as hard, it's because most people have no idea of how this economic system works. Now you can hate it, love it, I really don't care. What I want you to do is I want you to understand it. Because I want you to be able to build wealth in this economic system. And if you want to be able to build wealth, you got to understand how this economic system works. And in this economic system, the person that becomes wealthy is the investor. Now, that doesn't mean that investments always go up. Market crashes happen. Recessions happen. It will happen again. We will see asset prices fall. I don't know when, but it will happen. And that also creates great investment opportunities so long as you're planning on being a long-term investor. And this is why it's so important to understand this, because you want to know what's happening, why the bond market matters, because, well, at the end of the day, interest rates, well, they're going to fluctuate. You want to know why investors are getting concerned, and you want to know how the system works, because the average person has no idea. And they get burned every single day. You go to work, they get a paycheck, and that paycheck doesn't stretch as far because your rent gets more expensive, housing gets more expensive, cars get more expensive, groceries get more expensive, vacations get more expensive, and your raise doesn't keep up. And you wonder why. Well, in this economic system, it's the investors that become wealthier, while everybody else slowly starts to fall behind. That's why I want you to understand this. Again, if you want some more resources, you can join Market Briefs, my free financial newsletter. Plus, you also get my investing masterclass as a bonus just for joining Market Briefs. It's all free, and I have the link for you down in the description. If you have $100 in your bank account and you want to buy this $1,000 Gucci scarf, your bank would love to lend you the $900 at 25% APR, because when you make the minimum monthly payments, your banker gets richer. But that's just the beginning. When it's time for you to buy a house, who do you ask? How big of a house should I buy? Many times it's your banker, and they're not your financial